Coverage Metrics English, Interest and Fixed Charge Phrases. Welcome! Today we'll demystify coverage metrics, numbers that show whether a company can comfortably pay its financing costs. These ratios appear in credit analysis, board decks, and lender meetings, and they quietly shape borrowing terms. Strong coverage signals lower risk, greater stability, and disciplined leverage. Weak coverage points to tighter liquidity and potential covenant pressure. We'll focus on two practical tools: interest coverage and fixed charge coverage. By the end, you'll know how to explain them clearly, use the right phrases and updates, and connect movements to real business drivers. Exactly what stakeholders want to hear. Interest coverage tells you how many times a company's earnings can pay its interest bill. Put simply, EBIT divided by interest expense. EBIT means operating profit before interest and taxes. A higher ratio equals a thicker cushion, more capacity to absorb rate hikes, revenue dips, or one-off hits. A ratio near 1 signals vulnerability. Lenders and investors track this in quarterly updates because it reflects day-to-day resilience, not just headline growth. Example: with EBIT of 30 and interest of 5, our coverage is 6x, indicating solid protection against volatility. Use crisp, confident wording. Examples: our interest coverage stands at 4.8 times, gives a clear snapshot. Coverage improved quarter over quarter, or coverage contracted quarter over quarter, explains direction without drama. Tie cause to effect. EBIT growth offset higher rates, shows operational strength balancing financing headwinds. When covenants matter, reassure. We maintain headroom above covenants, then quantify it if appropriate. These phrases keep the narrative focused on capacity, trends, and risk buffers, exactly what credit-sensitive audiences need. Translate movements into drivers. Rate hikes pressured interest expense, connects macro changes to higher costs. Operational efficiencies lifted EBIT, credits margin work, pricing, or mix improvements. Flag anomalies. One-off items distorted this quarter, such as asset sales, restructuring charges, or timing shifts, and clarify what normal looks like. Show prudence. We model a conservative downside case, then note the buffer it implies for coverage. This framing is transparent, professional, and helps stakeholders separate sustainable performance from noise. Fixed charge coverage, FCC, looks beyond interest to all recurring fixed obligations. It often focuses on EBITDA before rent, because rent behaves like a mandatory payment. A common formula is EBITDA plus rent divided by interest plus rent. This reveals whether operating cash flow comfortably services both debt and lease costs. FCC is crucial in retail, restaurants, leasing-heavy sectors, and franchising, where rent and royalties are meaningful. Example: EBITDA 50, rent 10, interest 5, right pointing arrow, FCC equals 50 plus 10 divided by 5 plus 10 equals 4x, a solid buffer for lease-dependent models. Keep it straightforward and proactive. Fixed charge coverage is 3.6 times this year, anchors the discussion, address commitments directly. Lease commitments are fully covered, reassures landlords and lenders. Set guardrails. We aim to keep FCC above 3.0x, signals discipline across cycles. Acknowledge trade-offs. New leases will dilute coverage short-term. Then add the why, store ramp-up, market entry, or strategic capacity, so listeners understand the path back to the target range. Context builds credibility. Coverage is in line with peers, shows competitiveness. If stronger, Say so carefully. We exceed bank covenant minimums. Signals compliance and headroom. Provide a steady frame. Target range 3.5 to 4.5x through cycle. Balancing ambition with realism. Don't ignore patterns. Seasonality causes predictable dips, such as Q1 softness or holiday peaks, so stakeholders don't overreact to normal fluctuations. Benchmarks turn raw ratios into actionable signals for lenders, investors, and internal leaders. Lead with clarity. Define the metric, state the ratio, then add context. Always link movements to drivers and actions, pricing, cost work, refinancing, or portfolio changes. Use measured wording. We expect, we plan, indications suggest, to avoid absolutes and overpromising. Close with a forward view. The outlook, your target range, and risk mitigation steps, such as hedging, staggered maturities, or productivity programs. This polite, precise framing earns trust and keeps attention on resilience, not just this quarter's number.